Welcome to Making Money. This is Matt McCall. Thanks for joining me. It's February 23rd, 2023. It's a beautiful Thursday down here in South Florida. We got a really good show coming up for you. We're bringing Scott Garliss, an analyst here at Stansberry Research, with me back on the show. Had him on a few months ago, talked about kind of what the Fed was doing. He hit it right on the head. Talk more about what the Fed is going to be doing, what the market's pricing in, and why this is actually really good for stocks. We're also going to dive into Nvidia's earnings. Blockbuster earnings this morning, the big semiconductor breaking out, and what's going on with these diabetes drugs being used for weight loss and how to play that. A couple stocks that could be poised to rally on that news. All this and more coming up right now on Making Money. Last year, when most investors were watching their stocks plummet, one Wall Street legend had an unfair advantage that was identifying winning stocks with massive upside. Like Riot Blockchain before it shot up 10,090%, Digital Turbine before it shot up 789%, Overstock.com before it shot up 1,050%. This power gauge comes from the legendary Mark Chaikin. Right now, you can get a free in-depth look at how his power gauge system works. A way to type in any 4,000 different tickers and see exactly where the stock is most likely to go next and in any type of market. Simply go to powergaugepreview.com for a free look. Again, that's powergaugepreview.com. All right, so here he is, the man, Scott Garliss. Scott, thank you so much for joining me, coming back on the show. We had a great sit down a couple months ago, and I've been wanting to get you back on. And the last week in particular, just so everybody knows, Scott puts out a lot of great information. He's like a walking Bloomberg terminal. All the information he has in his head and shares it with all the other analysts here at Stansberry Research on a daily basis. And this week, I've been noticing a lot of information sending out about the Fed, about interest rates and kind of what their direction is. The Fed minutes came out yesterday for the most recent meeting. And it showed, Scott, that everybody who voted was okay with 25 basis points, but some were okay with 50 as well, but they all voted on 25 as unanimous. We have some outside Fed governors that aren't voting, Mester and Bullard, very hawkish tone coming from them. And now the next meeting, the next decision will be on the 22nd of March. Market's still pricing in 25 basis points from here. So talk a little bit about how things have changed from the beginning of the year to now and what you're seeing as far as kind of resetting these expectations for the Fed going forward.
Totally. So the first thing I'll say, like the biggest mistake I feel like everybody makes about the Fed is they get emotional about it. And you can't get emotional. You gotta look at the Fed and like, I don't dislike the Fed. I just look at it like, what's the investing outcome going to be from whatever they do or say? So I want to look at their numbers and be like, okay, well, there are implications for this, and I got to figure out what they are. And I've got to inform my investing decisions going off of that. So right now what's going on is exactly what you said. It's a concern about, hawkish Fed members and their commentary. And what's really driving that is earlier this month, we got the January jobs number, non-farm payrolls from the Bureau of Labor Statistics. That number was hotter than what Wall Street was looking for. And it saw a huge surge versus what we saw at the end of last year when they were decelerating. So the concern there from a lot of investors is if we're seeing the jobs market pick back up, that's going to mean the economy could run hot, inflation could run hotter. So the first problem with that is at the end of the year, the government did a bunch of adjusting because of Census Bureau data. So all of a sudden, the employment population in this country increased by about 1 million people. That's a big change. And so the number of people employed went up. I believe the number was by like 860,000. So those numbers had to filter through. So what we saw was seasonality in January probably drove the January employment numbers higher, whereas Wall Street economists really weren't sort of anticipating this, and they were thinking, hey, this trend's going to continue. So what that did was that got the short camp who'd been getting their butt kicked from the beginning of the year really fired up about, hey, inflation's picking back up. And then you had a January CPI number that came out not too long after that. And again, that's put out by the Bureau of Labor Statistics, and that's CPI stands for Consumer Price Index, in case anybody doesn't know what it is, and that's a gauge of inflation. So that was hotter than Wall Street expected, but it still decelerated versus what we saw in December. It's just the pace of deceleration versus what we've been seeing since June wasn't as great as we have seen. So the shorts jumped on that as well, and they said, hey, inflation's picking back up, jobs are picking back up, this is going to be a problem, Fed's going to have to start raising rates even more. Now, what we had after that was Bullard and Mester, who are very hawkish, meaning they're inclined to raise interest rates. Both came out and reiterated comments they'd made prior to the Fed's last meeting in December. What they said was, and what they also made these same comments prior to January, but what they said was, we would have supported a 50 basis point increase. And, we're sort of up at the 5.4% range for where we think peak interest rates need to go. Now, that would mean the Fed funds target range goes to 5.25% to 5.5% versus a current 4.5% to 4.75%. So the market, Fed had guided for a terminal rate of 5.1% this year when they put out their December summary of economic projections. So the market heard, or the shorts heard Bullard and Mester, nothing new, but they jumped on that and they said, hey, the terminal rate needs to go to 5.4%, not the 5.1% guidance. So they've laid into the tape. Bloomberg's of the world love that when the market's going up, they love the negative headlines, put it out all over the place. And it's sort of, so this week, the last few weeks, we've seen the market kind of freak out saying, oh my God, inflation's heating way back up and things need to come down. Now, the flip side of this, and sorry for the long explanation, but I'm almost done. The flip side of this is you have guys like Thomas Barkin, who's the Richmond Fed president, and Patrick Harker, the Philly Fed president. The couple others, Mary Daly made similar comments. They all said, look, we get it. This data showed a pickup in January, especially the jobs number, but they said there's typically a lot of seasonality in that stuff, meaning these adjustments can influence these numbers, higher. So we would really like to see this become a trend before we reacted. And every single one of these Fed governors, Bullard and Mester included, all said, based on the data we've seen so far, it's done nothing to change our opinions. So that part hasn't really been picked up and reported by the media. But they're all saying the guidance we have now, or where we want to see rates go, is exactly the same as how we felt back in December based on all the data we're seeing. So thinking all of a sudden that the terminal rate's jumping to 5.4% versus 5.1% is probably a bit aggressive. But if you do think the terminal rate needs to go higher, I can understand why you would sell stocks.
So that's interesting that the market, as you said, is pricing in the Fed being a little more hawkish than the Fed actually is saying that they're going to be. And that's a kind of a weird situation for me, because I feel like last year we were kind of undercutting where the Fed was going to go. We didn't think they'd have to raise them so much. And now we're kind of seeing the opposite. And that, to me, as a pure investor, Scott, is a positive to me, because we're pricing in almost the worst case scenario. So if we only raise interest rates 50 basis points more, say you do 25 in March, 25 next meeting, then we come in below what the market's expecting. That's a relief rally somewhere in there, in my opinion, and it leads to that. And the other thing is, you talk about the market pulling back. I think we're up about 4% year to date coming into today, and opening up a little bit higher here today. If you look at just the pure technicals of the charts, we're still above what was a downtrend line we broke above, which is now support. We're still above the 50-day and 200-day moving average on the S&P 500. So there's a lot of actually technicals that still look okay to me, even though we've had this bit of a pullback in the market. So I guess maybe I'm confused. We're freaking out because of a potential 5.4, but also we're holding up pretty damn well in the face of that.
Yeah, no, I feel the same way. I mean, a lot of the stuff we're looking at in terms of like technicals, yeah. I mean, you've seen what are golden crosses in a lot of instances, and that's where the 50-day goes to the 200-day to the upside, and that's a big change when that happens, especially considering the downtrend that we've been in for the last year. So it tells me there are a lot of investors, in particular institutional investors, that have a propensity to buy right now. Now, what is also interesting about all of this to me, money is flowing out of U.S. funds at the moment, U.S. equity funds, and it's going over to Europe. And the reason it's doing that, there's an argument for European stocks are cheaper than U.S. stocks. But what that also tells me, to what you were speaking to earlier, was, hey, look, if the Fed doesn't go as far as people are suddenly expecting, this new expectation of higher, it basically means that they're underinvested in the U.S. and money will come flowing back into the U.S. at some point. And so, if you try to chase it when that happens, that's a lot harder than if you're there ahead of time. Now,
Yeah,
I'm not,
sorry,
yep.
Go ahead.
No, go ahead.
I was going to say, there's another aspect to this, that the worry is that the economy is still too strong. We have the unemployment rate at 3.5% or 3.4%, 53-year low. We had retail sales come in pretty strong last month. There's still jobs out there for people. So I like that aspect as a pure American, and seeing that the economy is still good. I mean, I travel, I'm on a plane at least once a week, and planes are full. Airports are popping. I live in Delray Beach, and you can't go get a table on a normal night on a Monday or Tuesday. You have to get people are out spending money. And if the economy is about to go into a deep recession, as the bears will argue, this shit's not what it looks like. I mean, I'm old enough to know what recessions look like. It doesn't look like this. And again, investing to me can be simple a lot of times, Scott. Just look around and see what you see. It's not easy to digest this all, but I just don't see this calamity that's going to happen, that's going to drive things down so much. Inflation's going to come back roaring. I just find that hard to believe. But again, maybe I'm looking at it in a too simplistic way. But am I missing something? Because to me, things look pretty damn good.
No, yeah, it doesn't. Right now, it doesn't feel like we're going to have this super hard recession like some of these guys are calling for. To me, we don't want that. I mean, the shallow recession, soft landing, we'll see what happens. But I don't see why you want to completely destroy the economy. I don't see how that helps anybody. Look, frankly, if the Fed keeps going, and let's say they do go to 5.5%, I think that's going to be really devastating for the economy. One of the metrics we look at, we like to look through the credit metrics when they come out, and the New York Fed puts these numbers out, and credit debt has hit record levels, and there's a reason why. Because as rates keep going up and inflation's high, people are having a harder time meeting ends meet. And what they don't realize is that happens is that as they keep going more into debt, they have a harder time. Their disposable income shrinks more and more, because as interest rates go up, they have to pay more to service that debt. So the Fed has to walk a really fine line and be careful. Now, the December credit metrics, while they still went up, the amount of spending on credit cards got cut in half versus what Wall Street was expecting and where it was a month prior, I believe. So that's also a big deal, because that's like, hey, things are really slowing down all of a sudden. I mean, that tells me people are worried about that, and they're really realizing that these higher rates are eating into their disposable income. So yeah, the economy feels good, but I feel like we're getting to that place where if we're not careful, it could get bad quickly, and we don't want that.
No, I don't want that either. And on Tuesday's podcast, I wasn't planned, but I started talking about the Fed. I went on a little rant, and I'm not an anti-Fed guy like you. It is what it is. I'm not a big fan of them. I'm it is what it is. It's the Fed. But it started when I start. Buller he annoys me. Just because he's not voting, and I feel like he's in a great situation where he could say, I would have done 50, because if for some reason inflation does come back, he could say, hey, I would have done that. If not, we'll forget he ever said that, and the Fed did a good job. So he's in a win-win situation, because he's not actually voting right now. So I think he's playing the media, and he likes to hear himself talk more than I like to hear myself talk. So I kind of push Buller to the side a lot. But, I believe the Fed still, they're still human beings, right? So they were late to the game year and a half ago, let's call it, year and a half ago.
Yep.
And now I think they overcompensate. It's like that old pendulum. It went one way, and my fear is it swings too far and they do become too aggressive just because they're trying to chase their tail. And their legacy is going to be, we knocked out inflation and not worry about pushing the economy into a recession. That's the one fear that I have in this market.
Yeah, so I spent some time talking with an ex member of the Fed who was there when they started QE and helped through the whole process. And we spent some time discussing what's going on right now. And he said one of the big things is, he said they're very, very conscious of what happened in the 70s when they started raising rates, they started cutting, and inflation took back off. And he said they're really, because they were so late on the front end of raising rates, like you said, they're overly worried that they're going to get stuck with the legacy of, hey, we really screwed this up on the front and then we screwed it up again on the back. So they're cautious of letting inflation reaccelerate. So when you think about it that way, and you see the market going back up, well, of course, all these Fed governors are going to come out and say things to try to talk down the market, because their concern is, if people feel better about their investments in the stock market, that they'll go out and spend more liberally. And so it doesn't mean the Fed's going to necessarily act in that fashion, but they're trying to talk things down. And so, I kind of get that. But again, like you, I'm trying to look at the numbers and what the numbers are telling me and where rates are headed and what the investing implications and outcome are. And I feel like the markets, for lack of a better word, are getting overly draconian in terms of their outlook. And so, again, we'll see. There's nothing like opening my mouth and sticking my foot in. But it just, I feel like the worst case scenario right now is being priced in. And again, if you go look at the interest rate probability models, the market is expecting a 5.4% peak later this year, like July. And again, 3 weeks ago, that number was 4.9%. They actually expected the Fed would be cutting in the back half of the year. Now, all this said, when we looked at past interest rate cycles, what we've seen is the Fed, after they get to the end of their rate hike cycle, it's typically within like 4 or 5 months they have to start cutting again, because the economy gets hurt. So the flip side of that is, like, I think we talked about this last time, is when the Fed stops, that's when stocks really start to go. The average gain over 2 years is, I believe, 35.5%, 36% for the S&P 500. So, again, I don't think we're far from the end of this. If we add another 25 basis point hike, like, okay, it's not ideal, but that doesn't mean we're going right now. It doesn't feel like we're going to next December. It's so, maybe we go to like May instead of, hey, we're ending in March.
Yeah, so we have the March meeting, right? 25 basis points, I think the consensus right now. So that puts us 25 away from where the Fed still thinks they're going, 50 away from where the market's pricing in. So that takes us to the May 2nd, 3rd meeting, May 2nd, May 3rd, which maybe another 25 there. I think that's going to be kind of important when we get to that time frame. Okay, do they keep going from there? They talk about pausing in May. Obviously, the next couple of months will be volatile. I saw 35 trading days heading into today. 17 of them have had a 1% move or more. And the only time that we've had that many through 35 days was four or five other times since 1953. So pretty unprecedented. What was pretty, I think it's the fifth time. The four other times, Scott, this has happened, the market's been down pretty big. We're actually up 4%. So it's a little different than we've seen in the past. And all but 2008, the market actually did really well the rest of the year after that volatility. I don't want to use that as a reason to buy stocks, but it's just interesting to show the volatility. And I don't think that ends anytime soon, because the one thing the market hates is uncertainty, because we don't really know what's going to happen with the Fed. And that's a driving force, that and inflation right now. So we're kind of stuck. But let's shift gears a bit away from kind of the big macro and talk about the market. And, today we had Nvidia come out, or last night Nvidia came out with earnings, popping this morning up about $25 or so a share. I'm looking at the watch list here. It's on the stocks in our newsletter. Some really great numbers from a engineering firm, one from a solar company, one from a healthcare company, all breaking out today. What do you think of this market and some of these earnings that are coming out? Nvidia in particular, up $26 right now. Up well over 100% from the October low, which is pretty amazing for a company that size.
In terms of what's going on this morning and some of the stuff, like in particular tech, what's really interesting to me is AI, and I know that's something you care about a lot. And so we've seen some good numbers. We saw Nvidia, they're talking up AI demand. Obviously, for their semiconductors, that's going to be good. They make graphics processing units, and what they found is that AI companies, these GPUs that they make for video games, they work really well for AI. So Nvidia is seeing demand there, and they believe demand's going to pick up. So one of the things we're seeing with Nvidia this morning is, Nvidia took numbers out last year because they couldn't make sales to China. They're selling high-end chips to China. So they really cut their numbers low. The stock got pummeled. And then what they discovered was they can sell lower chips to China, or lower density chips are not as good quality, but they can sell more of them. And then this whole AI thing has really picked up. And to me, that feels like it has real legs going forward. Also this morning, Alibaba came out and reported numbers, and they were talking up AI demand from their cloud computing unit. Alibaba is also rallying. So, yeah, I mean, I think, we're on sort of the precipice of this really taking off. And I think tech companies in particular stand to benefit the most. My only caveat with what's going on with Nvidia this morning is, there's always a concern of China invading Taiwan. Nvidia's chips are all made by Taiwan Semiconductor. So until we see more diversification away from, say, that one main base, that could be an overhang in the stock. But I think with a sort of a washed out company, there's clearly a big short interest in this thing right now, or there's some shorts that have been all over it. I think there's some definite momentum here.
Yeah, and to me, this has been one of my favorite companies for many, many years, and had it in past newsletters, bought and sold it. I owned some myself back in the day for clients. And I'm kicking myself. We were talking for one on a show. I talk up NVIDIA, how important it is to the future of innovation, technology. And meanwhile, I don't own the damn thing, and it's up, 120% from the low in October, whatever the hell it is. It's, granted, I'd be break even if I bought it last April. So it's not like I'm saying, that I would have bought the bottom, but it's, to me, it's still, I wouldn't buy it here. I wouldn't chase it here personally, but I think it's a core holding though for me. And I think eventually it's $1 trillion company. I think it will hit that some point this decade.
You're not alone. I feel the same way. I recommended other people to buy it in December, and I did nothing. So.
The amount of times I've done that, Scott, too, the same thing. So another thing we were talking about too in the market is, and one of my analysts reached out to me earlier this week about it. It's Ozempic, which is the diabetes drug, and I have to admit, I as a New Yorker in my adult life, I read page 6 because after being in the media, I tend to find weird things about my friends or acquaintances in page 6 in the New York Post. And, New York Post talks about celebrities and stuff all the time. And there's been this thing about one of their housewives losing all this weight using Ozempic, using this diabetes drug. And you kind of see like celebrities all around are using, these drugs to lose weight, look better, obviously. And that's made by Novo Nordisk. NVO is a symbol. It's a European company. And you look at a chart of that stock, holy smokes. I mean, it's been on a huge tear as of late. What's your view kind of on healthcare and anything maybe specific to what I'm talking about with diabetes and kind of moving forward?
Sure. I believe it's Eli Lilly makes another drug that's come out. I think it's called Mogenero. Look, I mean, I think one of the things that we really saw with COVID was obesity is a real problem, because obese people had much more difficulty dealing with COVID and the symptoms than people who didn't. And again, what COVID really seems to do is it basically stresses your body when you already have some sort of ailment going on. It creates that much more stress with your body, and that's why people with obesity or asthma or something else, they had a harder time dealing with the symptoms and recovering. So I think, look, I will tell you this. I've told friends of mine in the past when I've gone out of the country on like surfing trips, I look around the airport, and in particular American airports, and I see a lot of people in sort of baggy sweatsuits because they tend to be overweight. And then when I go to foreign countries, I don't see as many overweight people. They tend to be skinnier, but it's a problem. So I think what we'll see more and more going forward is as insurance companies, governments realize, hey, look, if we can get obesity issues down, we can probably save ourselves a lot of costs in terms of other things that are going to pop up, like heart attacks, I don't know, joint problems, all these things, because they're happening because people's bodies are stressed because they're overweight and they're being taxed. So the money we spend upfront now to fix these problems on, say, like, Ozempic to get people's weight down, the long-term benefits of keeping that weight off and the costs that we're saving down the road, I think that'll be a game changer for these populations. And that'll be a game changer for a stock like this and for an Eli Lilly, because again, they're providing a benefit that is going to help people. And then, you can look at other things like, if you think people are going to live longer, what does that mean for, say, technology companies, consumer apparel companies? That creates more demand for their stuff. So yeah, that feeds back into the tech stuff you're talking about, and more people, more demand for goods. That'll keep that cycle going longer. But I think getting obesity down, now that doesn't mean you should just depend on this drug and do nothing. You should use this drug to help you get your weight down. And then you should go out and try to exercise more, because less weight means less stress on your body. But I do think things like these are real game changers societally, and we're just in the early stages of realizing these benefits.
We'll wrap up here, Scott. But before I wrap up, I asked you this last time, and I have to ask you again. I ask everybody in every single show the island question. I send you, family, friends away for 10 years to the beautiful island of your choice. What's the one investment you feel really confident with, not looking at your phone for 10 years, and that you feel will do really well for you in the next 10 years?
Hershey.
I love it.
People.
That's a Stansberry favorite too. That's been around for a long time, Hershey.
It's a great company. I've been nothing but happy since the day I invested in it. And it just, people like, that's one of my weaknesses. You're talking about, discipline with investing, exercise, health. But I tell you, one of my big breakdowns is chocolate. I had some Hershey's Kisses last night. I had about 7 of them. Not that I was
that surprises me, Scott. I don't see you as a sweets kind of guy. But we all have our little vice, right?
Yeah, and it's a lot of people apparently have the chocolate vice. So
Yep.
And not to mention, like, the Hershey Park as a kid, I love the place. We've taken my kids and they love it, and it just it's so. I think it's going to be, again, a boring. I love the boring type investments as sort of core stable investments, because they're not going to show you the sexy 200% upside tomorrow, but they're going to keep making you money, and you got to have them. And I will say this too, Matt. One of the things you would hit on about just the discipline in investing, I really recommend that everybody that listens takes a look at all of the Stansberry universe of products. And I would say you're best served from your portfolio perspective of having a mix of all the different, editors and what they recommend, and don't put all your portfolio in any just one of them. Spread it out over all of them, because we're all going to go through streaky times, and we're going to get hot, we're going to get cold, but over time it'll pay you well. So by spreading it out, you'll be diversified, and as each section sort of hits, you'll start to pick up gains from those. And then when they all start working at once, man, things will really work well. But yeah, by diversifying your portfolio and being spread out, you're going to be better off in the long run.
Yeah, even me, who's kind of typecast as the innovation tech guy, which I am. I love innovation, but I own a lot of boring stocks, personally in my personal account, and what I call boring, but solid companies. But you mentioned Hershey here. I look at the last 10 years, the S&P is up 216%. Hershey's is up 269. So even though it's this boring company, we've had a lot of different markets in the last 10 years. It's beat the market, and that's pretty amazing.
Yeah, another one, if I could throw another one out there too.
Sure.
And I know Warren Buffett and Charlie Munger may not be long for this world, but Berkshire is another great company. And for for people. They buy companies with great cash flow, good stable businesses, and they have a great track record of investing. And if you want to have exposure to a lot of different arenas, like I look at Berkshire right now as this really steady company that has a big position in Apple, that when tech really comes back, it's going to explode. The Apple position is just going to rip, and it's going to explode higher. So, it's another one. Like if I couldn't own Hershey, I'd be pretty happy owning Berkshire and going away for 10 years.
Again, up 200% in the last 10 years. So you think big, stodgy, boring, what are they, 99 and 98 years old or something like that? I mean, they definitely don't take our health, but somehow these guys are living to nearly 100 years. I mean, they eat a lot of crappy food. It's unbelievable. But it must be the low stress when you're a billionaire. It must make life a little bit easier, Scott.
Yeah. Well, I believe Warren Buffett only takes a $50,000 a year salary, but he gets paid a ton in just all that stock.
Yeah.
And that's where he really crushes it.
Yeah. Well, awesome, Scott. Thank you for coming back on again the show. We'll get you back here real soon, but obviously love your insights and keep up all the great work. I love it. Thank you so much, and we'll see you soon.
Matt, thanks for your time.
Opinions expressed on this program are solely those of the contributor and do not necessarily reflect the opinions of Stansberry Research, its parent company, or affiliates.